Personal income and spending hold strong while the equity rally cools off. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. We're kicking you off to the closing bell, but yet we're still at a record high.
Yes.
Maybe I'm going to change my tune.
I don't know. It depends on how things shake out over the next few years. You might actually end the week right.
So I might be right?
Yes.
Literally never happens. All right, let's get checking on where we are here. What Romane's talking about sort of the fade over the last hour, pretty much now flat on the day. Nevertheless, we are up for 7 straight days. We haven't seen that streak since November, and we're still at a record high. Individually, I just want to point out, so tech obviously the dragger, but the best stock within the S&P, you're at a record high. A 52-week high is American Express. It's not about their earnings, it was about their forecast actually looking better than estimated. And I also want to point out crude up by 1%. Watch this over the next hour. Trafigura reporting that one of their oil tankers was hit by a missile in the Red Sea. We're going to break this down for you in just a moment. And the 2-year yield up 7 basis points. Now this makes sense. You get that PCE coming down, inflation rolling over, and you have the front end sell off, yet equities managing to hold a teeny bit of their bid, Romaine.
Yeah, we're going to talk a lot about the macro today, but let's talk about the micro, because a bit of conflicting signals here on the economic front coming out of two companies. A tale of two stocks today with Amex and Intel. Intel shares sliding the most in about 2 years. This after that tepid forecast really renewed a lot of the doubts out there about Pat Gelsinger's long-promised turnaround of the once dominant chip maker. While Intel's personal computer business is recovering, demand for Intel's data center chips still weak. Intel also contending with a slowdown in programmable chips and components for self-driving cars, and that fledgling business that makes semiconductors for other companies, that hasn't even taken off yet. Meanwhile, the picture improves for American Express. That is your biggest gainer among big cap stocks today. Investor concerned that household finances were too stretched. That was assuaged just a bit today by the credit card company's earnings report, a report that showed an 11% jump in fourth quarter revenue, 23% jump in net income. Amex is better than consensus guidance, rooted in what we now know are pristine credit conditions and sustained consumer spending. And it's not just confined to Amex. Visa also posting profit that beat estimates, saying payments volume up 8% amid strong U.S. economic growth. And that brings us back to the macro, the monthly PCE data in the U.S., back in that narrative with inflation-adjusted consumer spending up 0.5 percentage point in December for a second month, biggest back-to-back increase in nearly a year, and that is fueled by another strong advance in wages and salaries. But Mohamed El-Erian calling the performance of the world's largest economy in the final months of 2023 remarkable. But Alex says it's still too early for policymakers to rest on their laurels.
True, but the outlook does look really good. I'm loath to admit it, but this chart really kind of tells a story. You forget the white line for just 1 second, but the orange line is the 3-month core PCE, and then the blue line is a 6-month core PCE, and then the pink line is overall core PCE, and they're all pointing to a downward motion. That's what was so interesting about the PCE today, is that if you put those trend lines together, they're all going down. To watch, though, is core PCE on a 1-month basis, ticking up a little bit, but still right around that 2%. Now, I appreciate that it's core. I appreciate the Fed's not going to look through any sort of inflationary impulse from, say, energy. But I mean, that's where the Red Sea stuff with Trafigura, for example, and that headline crossing does get interesting. That might bring back some cyclical inflation that the Fed actually can't handle. But for now, disinflation nation.
All right. I was still waiting for you to explain to me what the white line is, but maybe Sarah Wolf will be able to tell me. Did you?
I said 1 month. You weren't listening.
I listened to some of it. All right, let's get right to it. Sarah Wolf joining us right now to help kick us off to the close, senior U.S. economist over at Morgan Stanley. All right, my lack of attention notwithstanding here, I did pay attention to that report this morning when it came out. It looked good. I mean, we got a little bit of a preview of what to expect out of the GDP, the quarterly numbers the day before here. Is there some sustainability, though, in that strength that we're seeing in consumer spending?
I think we're seeing two things in the report this morning. The inflation side, which you mentioned, looks great. 3-month annualized pace is actually down to 1.5% for core PCE. That's a lot of progress. Fed's probably feeling pretty good about that. The other side, though, is income and spending, very strong. So how do you marry stronger economic activity with softer inflation? Does that raise the fear that inflationary pressures could reaccelerate later this year? Do we need softer GDP growth? 3.1% GDP growth for the year. I mean, that is way above any measure of near-term potential.
Well, we're at this sort of spot now where, depending on how you interpret this data, either this is that sort of immaculate soft landing, or, as you just said, this is sort of that head fake that maybe gets us into trouble. It really raises a question as to what the Fed is going to communicate to the market next week. We know they're not going to cut or raise, at least that there's nothing to indicate that. But they've got to give us some sort of sense here as to what they're thinking for the March meeting and beyond.
We think that there's going to be perhaps some small changes to the FOMC statement. They could acknowledge further progress on inflation. So add that word further in. They still have in their statement that they're highly attentive to inflation risk. Perhaps they can modify and soften some of that language because they are moving to a more balanced bias. They are preparing to cut rates, but we don't think that they're cutting rates anytime soon till June. So they are going to continue to push back against markets the way that we've heard from all the FOMC members over recent weeks.
Alex, there's another chart there. There's a white line on that.
There's a white line. I have no idea what it says. I can't read that far. But in talking about cyclical inflation, I appreciate you're going to say the Fed's going to look past any bump in oil and gas prices. Mm-hmm. I get you're going to say that because you're an economist. But nonetheless, the idea that kind of supply side issue stuff and sort of bottleneck stuff that the Fed can't actually control can sort of reaccelerate. How do we manage that risk as investors?
Undeniably, the biggest factor that's helped us achieve almost this 2% inflation has been supply side unwinding for goods and for labor, right? So supply side factors, shipping containers, oil prices coming down, that's all helped inflation come down, labor supply. So even though they're looking past headline inflation, if you see sustained pressures on the supply side of the economy, that does raise the risk of actual core inflation reaccelerating again. But let me emphasize, you need supply side factors to have sustained risk. So oil prices need to rise and stay high for quite some time.
I think the risk more is that then it affects sort of consumer sentiment and inflation expectations, where the UMISH kind of becomes really important. How do you think Jay Powell talks about inflation next week?
I think he's going to say that there's been progress, that they're getting better, but they're not quite there yet, that they still need to see a few more data prints. One thing we've been highlighting is that 3-month, 6-month annualized pace that we're all looking at that's looking really nice is going to start to actually reaccelerate in the next 3 to 4 months because of stickier services inflation. And so the picture's maybe not going to look as good as it did this morning in the next few meetings.
White line in my chart.
Yeah, we think they do.
My white line.
Well, if they do, I mean, let's just say they do follow that white line. I mean, obviously that's a big hypothetical, but it gets to a broader question here as to sort of what is sort of the main indicator. I mean, we were led to believe by Jay Powell himself that it was all about core PCE, maybe super core and maybe super duper core. But at the end of the day, if we've already hit those numbers here, why are we now pivoting to now focusing on something else that they haven't really articulated?
The Fed's moving what they're focusing on as the dynamic and the landscape is changing. So financial conditions were the main focus 4 or 5 months ago. Getting job growth below, that replacement rate was a big focus. And now they're moving off of that because they're learning about how the economy is responding in real time. And so now they want to look at the near-term momentum in inflation. If the Fed wants to stop looking at that, if Chair Powell actually thinks, we've made quite a lot of progress on inflation, maybe there's downside risk, they could drop that 3-month, 6-month reference. One thing we've been looking at is that new tenant index that's come out from the Bureau of Labor Statistics, and that's actually pointing to even softer shelter inflation in the back half of 2024. So we nudged down our inflation projections for this year off of that.
So is this now becoming more about a question of that glide path to the ground, or are we going to have to start maybe talking about the idea of a contraction?
We're not worried about a contraction, still rooted in the fact that the labor market is very strong. I know there's been a lot of debate. Can we look at the claims data? Can we trust it? We still think that with initial jobless claims this low, we're not seeing that pressure on layoffs. Job openings are coming down, but it's not feeding through into the unemployment rate. So even though things are cooling, these long variable lags in monetary policy, credit's tightening up, banks are pulling back lending, we don't think that it's going to be hitting the labor market that high. So we're not worried about a contraction, but definitely a slowdown.
All right, Sarah, great to have you. Sarah Wolf, senior U.S. economist over at Morgan Stanley, helping us kick off to the close here on this Friday afternoon with a 6-day win streak for the S&P 500 that include 5 record highs, potentially over here. We're going to talk about what's next for the equity rally with Tina Biles-Williams, CEO over at Exponents.
All right, plus merger meltdown here. Shares of Spirit Airlines sinking as hopes for a deal with JetBlue fade even more. We have the latest.
And a closer look here at the Biden administration halting the approval of new licenses to export U.S. LNG. We're also going to get you an update here on that fuel tanker that was apparently struck by a missile in the Red Sea. That conversation and so much more coming up in a bit. This is The Close on Bloomberg.
let's get back to that breaking news. Trafigura says that one of his oil tankers was struck by a missile in the Red Sea. Want to get more on this with our Bloomberg Balance of Power co-host Kayleigh Lyons for more. Kayleigh, do we know if this is an accident? Do we know if this is an escalation? What are you hearing?
No, we don't know necessarily what exactly happened here, Alex, other than that the ship is struck. It is actually now on fire, and that this is the most significant attack against an oil energy carrying vessel we have seen so far just with this conflict in the Red Sea. The Houthis have claimed responsibility for attacking this vessel. And of course, this is just one of many attacks we have seen really since November when they began these attacks on commercial vessels. Again, though, really the first time we have seen a significant impact on one that carries oil. Of course, we heard from the chief of the Houthis yesterday in a televised address pointing out that they have carried out attacks with more than 200 drones and 50 missiles so far, going on to say the U.S. is unable to stop Houthi operations in the Red Sea because, of course, Alex, this comes despite the fact that we have seen at least 8 strikes from the U.S. and the U.K. militaries against the Houthis and their capabilities in Yemen, going after their infrastructure, trying to degrade their capacity to carry out these attacks. And yet these attacks are continuing. So we'll see if we hear from the Biden administration on this, on potentially how they could ramp up going after the Houthis. But we do know that Saudi Arabia, for example, for years tried to stop the Houthis' ability to conduct these kind of operations and failed to do so. So this just really speaks to the challenges. They are saying, the Houthis, now that they are in direct conflict with the U.S. and U.K., in addition to any vessels bound for Israel. And to this point, we haven't seen much of it showing up in the energy market in particular because the flow of crude has been able to continue. If there is real question called into that, though, that is when we start to get perhaps concerns about the actual energy prices in addition to freight rates, which, of course, already have gone significantly higher as a result of vessels not being able to operate properly through this waterway.
Yeah, and Qatar LNG already sort of rerouting their shipments to Europe. Anyway, all right, Kayleigh, thanks a lot. Really appreciate it. Bloomberg's Kayleigh Lyons. Let's stay with energy for a moment. The Biden administration halting the approval of new licenses to export U.S. LNG to scrutinize how the shipments affect climate change, the economy, and national security. Joining us now is Bloomberg's energy and environment policy reporter, Jennifer Deloy. Jennifer, in my energy world, it was on fire today about this. I mean, everyone was really angry and said, you know what, it's just political. Come November 5th, November 6th, this policy will change. Do you feel like that's true, or is there teeth to this?
I think that is the real question here. We just don't know how long this will last. And if you are a developer or, have an interest in one of these multi-billion-dollar projects that is on the brink here and really affected here, assurances to just wait until after the election don't necessarily sound very soothing at this moment. I mean, the reality is the DOE, the Energy Department, is embarking on a study that will probably take many, many months, well past the November election. And at that point, they have a number of options, but could clearly bring the results of the study into future case-by-case reviews. Maybe they embark on a different process. It's just unclear what happens after the results of this analysis.
Well, I mean, the headline was certainly jarring here, Jenna, but give us a sense here is that actually who this applies to. My general understanding is that the whole point of this review was that there was a whole host of companies that we were shipping to outside the purview of our free trade agreements that for whatever reason, the Biden administration wants inside that purview.
Right. I mean, we're talking about exports that wouldn't be coming online until well into the end of the decade. These are projects that take a long time to build. The U.S. is already the world's leading LNG exporter. We exported about 11.6 BCF last year per day. Even with the existing approvals that are already in place, we could double that by 2027. What's at stake here really is about addressing the future of LNG exports beyond 2030, getting beyond that 24 BCF kind of threshold. This really impacts exports to our non-free trade partners, Asian countries and Europe. Clearly, Europe has been a beneficiary of a great deal, the majority, in fact, of U.S. LNG exports thus far.
Well, I was going to say, has European officials talked to the Biden administration about this at all?
What we're seeing right now is kind of a sense of that they are holding their fire, at least publicly. There is obviously a great deal of concern about Europe and ensuring that they have enough gas supplies to continue weaning off Russia. Of course, the underlying concern here is, and one of the motivations of the environmentalists who so aggressively push the administration to act and call this pause, is that gas infrastructure, gas flows today, may be fine and good, but we're worried about, and they are worried about emissions much further into the future. The idea that gas can come in the next few years is one thing. They're concerned about that displacing cleaner alternatives in decades to come.
All right, Jen DeLuey there. A closer look here at the big headline of the day. Biden administration halting LNG licenses for export here under a climate review. A lot more coming up here on the big program, including a closer look at Microsoft and Amazon and the big companies set to report quarterly results next week. D.A. Devison's Gil Loria going to be joining us about the common themes affecting the sector. That conversation up after the break, right here on The Close on Bloomberg.
Let's get back to that breaking news. Trafigura says that one of his oil tankers was struck by a missile in the Red Sea. Want to get more on this with our Bloomberg Balance of Power co-host Kayleigh Lyons for more. Kayleigh, do we know if this is an accident? Do we know if this is an escalation? What are you hearing?
No, we don't know necessarily what exactly happened here, Alex, other than that the ship is struck. It is actually now on fire, and that this is the most significant attack against an oil energy carrying vessel we have seen so far just with this conflict in the Red Sea. The Houthis have claimed responsibility for attacking this vessel. And of course, this is just one of many attacks we have seen really since November when they began these attacks on commercial vessels. Again, though, really the first time we have seen a significant impact on one that carries oil. Of course, we heard from the chief of the Houthis yesterday in a televised address pointing out that they have carried out attacks with more than 200 drones and 50 missiles so far, going on to say the U.S. is unable to stop Houthi operations in the Red Sea because, of course, Alex, this comes despite the fact that we have seen at least 8 strikes from the U.S. and the U.K. militaries against the Houthis and their capabilities in Yemen, going after their infrastructure, trying to degrade their capacity to carry out these attacks. And yet these attacks are continuing. So we'll see if we hear from the Biden administration on this, on potentially how they could ramp up going after the Houthis. But we do know that Saudi Arabia, for example, for years tried to stop the Houthis' ability to conduct these kind of operations and failed to do so. So this just really speaks to the challenges. They are saying, the Houthis, now that they are in direct conflict with the U.S. and U.K., in addition to any vessels bound for Israel. And to this point, we haven't seen much of it showing up in the energy market in particular because the flow of crude has been able to continue. If there is real question called into that, though, that is when we start to get perhaps concerns about the actual energy prices in addition to freight rates, which, of course, already have gone significantly higher as a result of vessels not being able to operate properly through this waterway.
Yeah, and Qatar LNG already sort of rerouting their shipments to Europe. Anyway, all right, Kayleigh, thanks a lot. Really appreciate it. Bloomberg's Kayleigh Lyons. Let's stay with energy for a moment. The Biden administration halting the approval of new licenses to export U.S. LNG to scrutinize how the shipments affect climate change, the economy, and national security. Joining us now is Bloomberg's energy and environment policy reporter, Jennifer DeLuey. Jennifer, in my energy world, it was on fire today about this. I mean, everyone was really angry and said, you know what, it's just political. Come November 5th, November 6th, this policy will change. Do you feel like that's true, or is there teeth to this?
I think that is the real question here. We just don't know how long this will last. And if you are a developer or, have an interest in one of these multi-billion-dollar projects that is on the brink here and really affected here, assurances to just wait until after the election don't necessarily sound very soothing at this moment. I mean, the reality is the DOE, the Energy Department, is embarking on a study that will probably take many, many months, well past the November election. And at that point, they have a number of options, but could clearly bring the results of the study into future case-by-case reviews. Maybe they embark on a different process. It's just unclear what happens after the results of this analysis.
Well, I mean, the headline was certainly jarring here, Jenna, but give us a sense here is that actually who this applies to. My general understanding is that the whole point of this review was that there was a whole host of companies that we were shipping to outside the purview of our free trade agreements that for whatever reason, the Biden administration wants inside that purview.
Right. I mean, we're talking about exports that wouldn't be coming online until well into the end of the decade. These are projects that take a long time to build. The U.S. is already the world's leading LNG exporter. We exported about 11.6 BCF last year per day. Even with the existing approvals that are already in place, we could double that by 2027. What's at stake here really is about addressing the future of LNG exports beyond 2030, getting beyond that 24 BCF kind of threshold. This really impacts exports to our non-free trade partners, Asian countries and Europe. Clearly, Europe has been a beneficiary of a great deal, the majority, in fact, of U.S. LNG exports thus far.
Well, I was going to say, has European officials talked to the Biden administration about this at all?
What we're seeing right now is kind of a sense of that they are holding their fire, at least publicly. There is obviously a great deal of concern about Europe and ensuring that they have enough gas supplies to continue weaning off Russia. Of course, the underlying concern here is, and one of the motivations of the environmentalists who so aggressively push the administration to act and call this pause, is that gas infrastructure, gas flows today, may be fine and good, but we're worried about, and they are worried about, emissions much further into the future. The idea that gas can come in the next few years is one thing. They're concerned about that displacing cleaner alternatives in decades to come.
All right, Jen Louie there. A closer look here at the big headline of the day. Biden administration halting LNG licenses for export here under a climate review. A lot more coming up here on the big program, including a closer look at Microsoft and Amazon and the big companies set to report quarterly results next week. D.A. Devison's Gil Loria are going to be joining us about the common themes affecting the sector. That conversation up after the break, right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with American Airlines. Helene Becker over at Cowen upgrading the stock to outperform, calling the company's updated guidance very achievable. Becker also notes that American seems to have hit a stride in operations that's helping to reduce costs, and she's looking ahead to that investor day in March as a potential near-term catalyst. Shares nevertheless down about 2% here on the day. Next up, let's take a look at Coinbase, getting a raise to outperform over at Oppenheimer, which cites a number of catalysts ahead. The analyst says the crypto platform has a good chance of prevailing in the SEC lawsuit against it. He also says spot Bitcoin ETFs are going to be a net positive for the company. The share is doing okay on the day, up about 3.4%. And finally, Snap. Lifted to buy from hold. This over at Deutsche Bank. Analyst Benjamin Black there sees a clear, strong path to revenue and EBITDA growth driven by improving sentiment in the digital advertising industry. Yeah, shares only up fractionally here on the day. A conviction call as part of our top calls. We do want to stay in the sell side space and pivot ahead to next week. It's going to be a big week here for earnings, a big week for tech. It's time to shine. Microsoft, Alphabet, Meta, Apple, and Amazon, 5 of the magnificent stocks set to post quarterly results. For some insight as to what to expect, let's bring Gil Loria into this conversation, Managing Director and Senior Software Analyst over at D.A. Davison. All right, Gil, I want to start off with Microsoft here because this kind of seems to be, at least over the last few weeks, the relative outperformer in that magnificent 7 space here. What do you expect that they can give you, they can say in that earnings report next week and on that conference call that might be an upside catalyst for this stock?
Well, most importantly, of that list of companies, Microsoft may be the only one that will have accelerating growth this year, significantly so. First and foremost, in its Azure business, they are gaining share, and they can point to the generative AI being the driver for that share gain. But then more broadly, they're transforming the rest of their product set using some of these capabilities, driving enterprises to adopt their products more, to upgrade to higher tier products. And so if Microsoft could get on the conference call, guide for a year of accelerated growth, point to Azure having at least that 26 to 28% growth for this year, I think investors will be happy.
All right, what about, let's pivot from Microsoft to another big one, and that's Amazon. I mean, the stock has managed to sort of hold its own with Microsoft, at least since the last earnings report, but the sentiment just seems to be a lot different there than with Microsoft.
With Amazon, there's going to be 2 important tests. One is, can the retail business maintain and expand its margins from here. The retail business has been notoriously swinging from profit to loss over the years as they invest in the growth, which seems to have still a very long runway. We believe that they've invested so much, especially in that 21 to 22 timeframe, that they can absorb some of those investments and grow margins in that business. And then on the AWS side, they've gotten a lot less growth driven by generative AI than Azure, but that could change. They've had a year to invest in the product set to compel their customers to build generative AI applications on AWS, which is still the market leader. If they can show results for that, if they can show accelerating growth for AWS, investors are going to like that.
So what kind of growth would that look like? Because you look at sales for AWS in the third quarter was 12%. The margin was the standout at 30%. Relate that to what we might see next week.
As long as they guide for acceleration, that's good. And they need to point to generative AI's contribution. Remember, they're growing that business from a much larger base than Azure, right? It's a $90 billion business to Azure's $60 billion business. So their 12% growth is adding just as many dollars. But for investors to get excited about the story again, they need to accelerate from there. They need to talk about 13, 14, 15% growth. And they need to indicate that that is coming from generative AI in the same way that Microsoft has been able to say about Azure that 3 points of growth in Azure are coming from generative AI customers.
Gil, I'm having a hard time getting excited about Apple. I feel like that's sacrilegious in the market, but we all know that iPhone sales are going to be struggling. Maybe we get a little bit of visibility into the Pro Vision headset, or Vision Pro headset, I should say. What should I really try and get excited about?
It's going to be hard to get excited about iPhone numbers. The upside there isn't very significant. There's a couple of things that investors could get excited about. If we see, let's say, more than 400,000 or 500,000 units of Vision Pro sold, that's an actual number. That'll approach 1% of sales for Apple in 2024. That could get people to think that maybe Apple still has innovation in it, that we shouldn't get discouraged about their ability to innovate in new form factors. I don't expect there to be a lot of follow through because it's a very niche product, but that's what we'd be looking for. And then the next thing is in June, if they talk about meaningful generative AI capabilities that are going to be built into Apple products and possibly tying that to the next iPhone upgrade cycle, then maybe we'll have a reason to get excited.
So put this all together for us, Gil. I mean, when we talk about these individual companies, of course, a lot of people are really want to know here, is big tech really going to sort of be the ballast for this market in 2024 the way it was in 2023? So when you look at these individual stories and you add them all up here, is there an answer that we can divine?
That as a group, I don't expect the performance to continue to be so much higher than the market. But in the individual cases, especially Microsoft, to a certain extent Amazon, those could continue to outperform because their multiples are within the historical ranges, and their numbers are still have the potential to accelerate this year. That could justify the current and maybe even a higher multiple. For the rest of the Mag 7, we're going to see that change over time. Meta's going to have a harder time. Google, there's been some struggles there. Tesla just reported and had a very interesting conference call. NVIDIA, by the way, is going to have a fantastic year this year, but investors are going to start asking more and more about next year. What happens when Microsoft and Meta are done buying GPUs? Who's going to fill in and behind them?
All right, Gil Luria, thanks a lot. We appreciate it for joining us. He joins us from D.A. Davidson and talking about interesting conference call for Tesla. I don't know. I think Dan Ives called it a tsunami or a level 4 earthquake or something.
Yeah.
Negative from Dan Ives.
Well, that happens when, you don't actually provide any real, concrete guidance.
Or even say slow down. There is no word slow down.
Absolutely here. All right.
Okay, it's me. Will the January rally continue? We'll break that down. This is Bloomberg.
Just about 3:30 here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So I was just starting to get constructive on the record rally that we've seen in the 7 days, and now we're in negative territory for the S&P. So see, I'm a counter indicator.
Yeah, just a bit fractionally here, and we should point out, of course, a lot of that is because of Intel. You X out Intel, and actually we'd be a little bit higher here on the day. The question is this really sort of, I guess, a reassessment of that rally or just kind of a one-day speed bump? And we were just talking, of course, some big earnings next week among some of the biggest weighted companies in the S&P 500.
Right, but if tech kind of rolls over and they can't hold up on their earnings front, that will just drag down the market.
You don't think those Vision Pro goggles are going to be the next catalyst higher for this market?
No.
Did you not buy one?
No, heck no. You
They're
kidding?
only like, what are they, like $3,400?
I had like an iPhone 12 for like the longest time. In fact, I think I still have an iPhone 12.
Okay, that's not that old.
No, it was iPhone 7? I had a really small phone for a very long time. Nevertheless, even if we close lower for the S&P, it's still been a relatively strong year for the equity market. The S&P is now up about 2% in January, just a few more days to go in trading. Now, Bespoke Investment says that, quote, positive returns in the month of January also tended to be followed by more positive returns for the rest of the year. Now we know how that goes, right? Past doesn't make future. But they did point out in the 31 years since 1953, when the S&P 500 was up 2% or more in January, its median performance for the rest of the year was a gain of 13.5%, with positive returns 84% of the time. Let's get more insight into all of this and where markets are headed. We want to bring in Tina Biles-Williams, CEO, CIO, and founder of Exponence, a $14 billion multiple strategy investment company. Tina, it's great to chat with you. Okay, so what do you think? As goes January, goes the rest of the year?
I hate to be the Grinch that stole the punch bowl from this party. But look, there's some good news. The inflation tide is clearly turning. For the second quarter in a row, core prices rose at the 2% target. But the question is whether the central banks will validate the market's optimism on rates, particularly in a presidential year, which fairly or unfairly will invariably politicize the the FOMC's reaction function. I'll just say, you just mentioned the statistics. I'll say that for every 6 months prior to a presidential election, the only time the Fed has raised rates was in 1980, when inflation expectations had become unanchored. But why am I less sanguine? Well, 4 reasons really is the pandemic-related excess savings that powered consumer spending and allowed us all to avoid a recession will begin to get exhausted by about mid-year.
Yeah.
We are already seeing early signs of a cracking labor market, which will gather speed as job openings trend lower. We're seeing cracks in the corporate sector in terms of elevated default rates, tightening lending standards, and rising delinquency rates in the commercial sector. And finally, as the Chicago Fed said, the lagged effects of the Fed's tightening are just beginning to be felt.
Yeah.
So I put those all together, and I'm not quite as sanguine.
Okay, Tina, that's a lot to unpack here. So let's try to sort of find some openings here for optimism. Even if you have that type of view that you have, of course, you still have an obligation to find investments and find a way to sort of make returns here. So where do you do that? Based on what you said, it doesn't appear that equities are part of that plan, at least not in a material way. Where does the money go?
So I'd be neutral, and I'm neutral at the beginning of the year. But as we get closer to that point, I think, the risk-reward balance goes towards bonds, where rates are obviously, if I'm right, rates are obviously likely to fall. And so it would be a fortuitous time to extend duration.
You think we're going to see? Do you think we're going to see a bigger drop on the longer end of the curve than on the shorter end?
Yes.
Oh, wow. Okay.
And that's because things are bad, Tina, basically?
Well, I think that we will face a slowdown, for all the 4 reasons I just mentioned. The areas of risk, in addition to stocks, obviously, are high yield, high yield are their corporate spreads are pricing in a default rate of 4.4 over the next 12 months, which is below the trailing 12 months default rates, which is about 5.2. So obviously, if we have anything less than a soft landing, that assumption gets a bit challenged.
But I just one question here, Tina, because this seems like a situation that if it does play out as you said, there are going to be a lot of people that are positioned on the wrong side of it here. Is there a case to be made for maybe taking a more optimistic positioning, tactically speaking, in risk assets with the proper hedges, with the idea that maybe, just maybe, that soft landing is achieved?
Oh, I think, the last gasp is always pretty, attractive, which is why I said I'd be neutral at the beginning of the year. But I just think that it gets a little, we get into more dangerous territory, sometime in the second half of the year. I don't think, let me be very clear, that we're at risk of the Fed hiking again, because that's where sort of the politics of the presidential election will, I think, restrain the Fed, even if inflation starts to raise its head.
So Tina, aside from maybe sitting in the long end a little bit, where's my safety play if the scenario that you expect plays out?
I think bonds, basically. Certainly if you're in hedge funds, managed futures, if you're in private markets, distressed debt, are all areas that I think will thrive in this impending market.
All right, Tina, great to catch up with you again. It'll be interesting to see how this plays out over the next few weeks and months. Tina Biles-Williams there, a co-founder of Exponents, of course, the mashup of FIS and Piedmont. A closer look here at the expectations for the year. And I think it's kind of interesting when you kind of hear this a perspective that Tina just gave us. It really gets to this idea that there really isn't a lot of consensus right now in this market as to where things are going to go.
And that's why you've seen so much volatility, particularly within the bond market, right? When you have 100, 150 basis point range, is that a range, or is that just like no one knows what's happening?
And I thought we were kind of past that volatility, but listening to her and some of the other guests we've had over just at the start of this year, I think we might be in for a repeat of that, not because they're predicting the volatility, but they have such differing opinions about where rates are going to go.
Yeah, exactly. And the timing and sort of how fast and how long, not necessarily when, but then how long the cuts go on for.
All right, we are counting you down to the closing bells. Just about 22 minutes until we get there here. The broader market slightly lower on the day, but still some big individual movers, and that includes Spirit Airlines. Apparently that company now at odds with JetBlue about the fate of their potential merger. Shares down about 12% here right now in the cash session. That's our stock of the hour. That discussion coming up after the break. This is Bloomberg. It's time now for our stock of the hour. A closer look at Spirit Airlines. Saved the ticker. The shares down more than 12% here on the day. This after apparently JetBlue comments out of JetBlue saying that they might be willing to walk away from that merger as soon as this weekend. Abigail Doolittle joining us right now for a little bit more on that. And that appeared to be the catalyst for the drop in the shares today, although we should point out those shares have been on the back foot for a while because investors all speculating this deal isn't going to get done.
Yeah, absolutely. I mean, the saga just goes on. To your point, so into this week, we had the shares down about 80% after the federal judge agreed with the Justice Department blocking the deal. So let's break it down just a little bit more from the JetBlue possibility first, because first of all, it seems as though there's a disagreement about the 2022 purchase agreement terms, because JetBlue came out today saying that they think that it's terminable on or around Sunday because of certain terms. So there's two possibilities. One, they really want out, and they could want out because there's a lot of difficulties in terms of this merger behind the scenes without going into it. Two, they may be trying to rework the deal to get a lower price because this stock is literally 80% lower than the price that they agreed to.
Yeah.
So we don't know exactly exactly there. Two companies did come together to appeal. That was probably mandated by the agreement. From the Spirit Airlines standpoint, it's very clear what they want. They want this deal to go on. So when they came out last week to defend the stock after it fell 80% after the judge sided with the Justice Department, they said that it's fully in effect at that point. And then today, they came out a couple hours after JetBlue said that they think that the deal could be terminable, saying that they believe that they're abiding by all the terms and they expect JetBlue to do the same. So there's a disagreement in there around the terms. We don't know what that is exactly, and we don't know what side is right.
Yeah, also I'm looking at Spirit's stock. I think when the deal was announced, it went down 50%.
When the deal was announced in 2022?
Well, actually, sorry, in the back of 2023, the stock was already down 50%. I'm sorry, that's what you're talking about in terms of it's so much cheaper now. Why would they even want to pay the X amount of $3.8 billion, $8.3 billion.
Exactly. And you have to wonder, is JetBlue trying to pressure Spirit into taking, say, a $10 price or $20 price or, something significantly lower just to save them? Because bankruptcy is not out of the question entirely for Spirit. Now, they have taken steps to limit the cash burn. And last week when they came out and said that they're going through with this deal, they said bankruptcy is not an option if it weren't to go through, playing the hypothetical. At the end of last year, they had $1.3 billion in liquidity. They've taken steps to shore up the cash. They will also be receiving money from Pratt & Whitney due to the geared turbofan engine inspection program. That could be about $300 or $400 million. If this deal didn't go through, there's a termination fee of about $427. But the biggest deal is the 2025 maturity debt that are backed, get this, by the frequent flyer program. So they may actually be able to work with those bondholders to get them to extend it, only because that backing, if they did go into bankruptcy, they probably get nothing. So, this is just a very complex situation.
Yeah.
Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. You have to wonder, though, have you ever flown Spirit?
No, I have not. I didn't even know they had a frequent flyer program. They have an interesting reputation.
Yeah, like one that I'll never fly. I used to fly them a lot in my 20s, which, granted, was a while ago. But still, I think that at this point, when you have the ability of like a Delta, United, and American Airlines to discount their prices and economy as much as they need to get people in the seats, how does a Spirit work?
Well, the discount world has really been upended. And remember, when this deal was announced, there were a lot of questions as to why JetBlue would go down this path, at least in terms of sort of integrating itself with the culture. Obviously, there's a whole other conversation there about the plane orders here. But I can tell you this. Everyone's so focused on SAVE shares, but take a look at JetBlue shares. 5% today, 10% on the week, up for a second straight week. I think JetBlue shareholders are letting you know what they really want.
The market doesn't want the deal anymore. All right, coming up, all eyes on the Fed next week. Our next guest says the Fed's goal of 2% inflation isn't going to happen. She has a different number in mind. We're going to speak to her next. Uma Moriarty coming up. This is Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Alex Steele. 10 minutes, Alex, until we get to those closing bells.
Some interesting names, though. We got some 52-week highs in here, despite the fact that the S&P is kind of going nowhere fast. We have American Express and Amazon both sitting at 52-week highs. American Express forecast looking really good. Amazon reporting next week. On the downside, obviously, Intel, worst performer in the S&P. And check this out, Carnival. Here's why. They had a 10K. And they said, quote, we believe that the instability in the Red Sea region currently impacting shipping could have an impact on our results of operations. Two questions. One, who takes a Carnival cruise through the Red Sea? Two, maybe you do, I don't know. And then two, now that you have Trafigura being hit by a missile, does it make all of this risk now a little more relevant for certain companies?
Yeah, you go through some of the routes that they have advertised on the website. Quite a few of those cruises at least go around that area, not necessarily do the Straits of Hormuz, but around skirting that area. So I guess if they have to either adjust those routes or cancel them altogether, that could have a material impact. We are 9 minutes away from the closing bells. Let's get to Uma Moriarty, Senior Investment Strategist and Global ESG Lead over at Real Estate Investment Manager Center Square. Uma, thanks for being here on the program. There has been a lot of talk right now about kind of what's really driving markets. And we were talking so much about all the economic data we got this week and how that feeds into the macro. And I was just kind of taking a look at where rates have kind of gone in all this, which is, quite frankly, not really anywhere. They seem like they've kind of settled into this little bit of a lull. And I don't know if this is sort of the end of all that volatility or whether we should really be anticipating a breakout in rates either higher or lower.
Yeah, thanks for having me. It's great to be back. as we think about where rates might be, especially on the long end of the curve, right? If we break it down into kind of the structural aspects of that, which is inflation and growth, there are some things that we think are going to probably keep rates a little bit higher, closer to this 4% range, despite what the Fed might do to the short end of the curve, right? And so as we get a little bit more data that might support that view, I think we might find a little bit more stability here on the long end of the curve.
So what does that look like, though? Are we talking about this idea here that if you have that stability, that is a reflection of what? Worse economic conditions, or basically where we are right now, which is sort of this, I guess, general belief here that we are in some sort of Goldilocks or soft landing scenario?
You know, whether or not we achieve a Goldilocks or soft landing scenario, I think is yet to be seen. One of the things that we're really mindful of here at Center Square is just really monitoring the strength of the underlying consumption, right? We've seen a lot of things driving consumption here, and it's all been fueled by debt. I mean, the amount of increase we've seen in terms of buy now, pay later programs, fueling a lot of the consumption that we saw even during the holiday season. All of this consumer spending has been really fueled by growth. We're seeing savings rates come down. We're seeing out of a lot of these earnings, especially from some of these tech companies, layoff announcements day after day. So you kind of question, right, how far can this consumer still sustain this level of growth, and whether or not that allows us to have what a lot of people are expecting to be a soft landing.
Uma, I gotta say, I feel like I've been hearing that statement for like 6 or 8 months, and yet that moment like still hasn't materialized. Why is this the moment?
Yeah, you know, it's been interesting trying to really understand kind of this long and variable lag that we've seen between when we get some of these policy types of movements from the Fed or from policymakers and when that actually impacts the real economy. And we've seen this rolling recession really go through various aspects of the economy here, but it's still not hitting the consumer. A lot of that is driven by the fact that we had all that excess saving. And now you're seeing other things like these buy now, pay later programs really fueling into consumers that still just want to spend.
So this is setting us up for next week, which is going to be, I mean, hopefully dramatic, because drama is fun, right? You got the Fed, you got the refunding announcement after the market took down a lot of supply this week in the belly of the curve. And then you have the jobs data. What's the best safety trade when there's so many variables we have to factor in over the next week?
A lot of the things that we're really focused on here at Center Square, being real estate investors, really focus on fundamentals at the asset level. Think about things like from the perspective of demographics, right? We have all of these people aging into the older generation, baby boomers that are aging into the need for healthcare. So something that we're really focused on is an area like senior housing, right? Regardless of what happens in the economy, the demand for that is pretty much set in stone because of this aging demographic wave that we're seeing coming into that cohort. And so those are the types of things that we're focused on, things that are more secular in nature rather than cyclical in nature, and then also really focus on making sure that these companies have a strategy as it relates to their balance sheet, making sure in the real estate space, right, we're seeing a bit of a reset happening in the private markets. What that allows for public companies is to really deploy their balance sheets in a way that can capitalize on some of that reset that's happening in the private market and grow earnings from that perspective as well.
How much of some of those companies in the real estate space taking advantage of, I guess, the cushion that they quite frankly got last year? The idea that we were falling off this cliff, that cliffhanger never really came here, but it's still kind of looming out there down the road here. Has there been enough time for some of these companies to reset and maybe prepare for when things finally do start to get tougher?
Absolutely. The public REIT market going into this kind of downturn that we're talking about here are only about 30% levered, right? And most of their debt is coming from unsecured markets at fairly favorable rates. And so what that means when they're comparing this kind of cost of capital advantage to a lot of what's happening across the private market in the real estate space, the companies across the REIT market have the capacity to really deploy these balance sheets that they have carefully constructed to be able to really play offense in a market like today.
And this gets us back to this idea here that if you are already invested in this space, I can understand why you stuck with it. For those folks who maybe either pulled out or just quite frankly been on the sidelines, Uma, is there an advisement here to enter?
We've seen historically when the Fed's kind of gets to the end of their rate hiking cycle, REITs tend to outperform, and they outperform not only broader equity markets, but also private real estate as well. I mean, we saw a bit of the rally happen in the REIT market to close out the year last year once we started to get a little bit more certainty, I would say, as it relates to no more additional Fed rate hikes. Obviously, we'll see the commentary coming out of the FOMC next week as well. But once we get to a point where the market is accepting the fact that we're no longer tightening conditions further, REITs can really rally here. And so that's what we're really focused on.
Uma, great to catch up with you. Uma Moriarty there. Have a great weekend. Senior investment strategist and global ESG lead at Center Square Investment Management. Counting us down to the closing bells here with about 3 minutes left to go here, Alex. And stocks are pretty much where they were when we started off the program about an hour ago. Modest losses, I should say, on the S&P and the NASDAQ. That rally, at least for today, now over.
We are no longer at a record high.
No longer at a record high.
This is a moment.
Did you shed a tear? Did you sell it all?
No, I was like, oh, I was right. Too bad
Yeah.
that I was getting constructive just like 20 minutes ago.
The interesting, though, is when you look at that PCE data, and there is, I guess, a lot you can hang your hat on in terms of economic data, the idea that volatility in the equity space has been tamped down, and you're not really seeing the huge ructions in the commodity space and some of the other correlated asset classes here. So maybe there's a foundation there. But, of course, that could change next week. We had 100 S&P companies reporting, including the big daddies of them all. Here, stick with us here. We're going to have a full breakdown here as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, those folks streaming us on YouTube. And before we get to the markets, Carol, I have to congratulate you for finally, for the first time, I think, in a couple years, working a full 5-day week.
Are you kidding me? Oh, my God.
Alex likes this.
Wow.
Alex likes this, Romaine.
I thought you were my friend.
Me? I didn't say anything. I'm so out of this. I mean, I've also been sick for like 2 months, so I'm not one to throw shade.
Oh, my God. Oh, my God. I am here, folks, when I'm supposed to be. Having said that, I don't even know where to go with this. Tim, it's all yours.
Sometimes Romaine throws these curveballs, and you just have to be ready for them, okay?
It's like, are you talking to my brothers? The way you give me a hard time, man.
Yeah, but it's all part of the fun.
I know.
We're not ganging up on you,
We
Carol.
love.
I'm here to defend Carol.
Yes.
Okay, I'm going to get us back on track also.
Thank
okay?
you.
We had a great conversation with Vance Howard over at Howard Capital Management. Despite the uptick we saw in 2023, he said he's really bullish on 2024. He's buying at the pullbacks right now. He says the market is broadening out. And also, Alex, he answered a question that Carol and I have been asking everyone. What happens to the cash that's in money markets when interest rates do go down? He's bullish on that going into equities.
I mean, yeah, or does it go out the curve in the bond market?
That's what I asked him.
Yeah.
Yeah.
But also, I think the idea here is it doesn't have to belong to one thing. Like, why can't it belong to, like, a bunch of stuff? It doesn't have to all just belong to the long end of the bond market.
That's true. It can go a lot of places, right? Yeah.
All right. Well, we're getting the closing bells here in New York as we wrap up what has been a pretty wild week here. A mixed bag here for the major equity markets, even though we should point out on a weekly basis, most of them are going to finish in the green. As for the day, the Dow Jones Industrial Average higher by 60 points or 0.1%. The S&P 500 lower only by less than 0.1%, down about 3 points, right around that 48.91 level. The NASDAQ Composite down 55 points or 0.4%, while the Russell 2000 is actually going to finish today higher by about 0.1%. And that is actually your outperformer, Carol, on a weekly basis as well, with the Russell up 1.7% here on the week, outpacing pretty much everything by a significant margin.
All right. So looking at the S&P 500, folks, kind of an even split, 271 names to the upside, 229 to the downside. Guys, want to guess what's the best performing name in this 5-day work week that I worked? Do you want to guess what's the number one gainer?
Netflix.
You cheat, man. Yeah, it is Netflix, actually.
I cheated.
No,
that was like the story of the week.
All right, the bottom of the pack. Bottom of the pack.
I was like the $200 clue on Jeopardy.
I know. It was like the easy
bottom of the pack.
The easy quiz question on the Bloomberg quiz. What's at the bottom of the pack?
Yeah, I'm really bad at Jeopardy.
Tesla's-
Let's put that out there.
No, this I would expect you to maybe know.
Why? Because is it a commodity? Is it oil? Is it something related to oil? Is that why you're saying that, Alex?
ADM down about 24%.
Oh, commodities. Okay.
That's a very idiosyncratic story, by the way. But still, that was really brutal when you have sort of accounting issues from your CFO. But guys, let's take a look at IMAP just to sort of round out the day here to see what sectors did well, what sectors did not. No surprise, tech. Bad. That is the worst performing sector within the S&P, down by about 1 percentage point. That's really led by Intel. Also, industrials off a little bit, so a little bit of risk off there. But energy and healthcare and consumer discretionary, consumer staples, all in the green on this day. It's hard to take a real read from today, except American Express did well and Intel did not, Carol.
I like the bad. Do you have a dog now at home?
Me?
Yes.
No.
Oh, it sounded like bad. Anyway, all right.
No, I have a 9-year-old.
Oh, no, she's good. I know that. All right, let's talk a little bit more about American Express. Number one gainer, Alex mentioned it. Number one gainer in the S&P 500. This went up, about 7% in today's trade, hitting an intraday record high. I don't know if it was a record close, so forgive me that I did not check that.
It is. It's record.
Thank you very much. All right, so Amex reporting fourth quarter profit revenue. It did fall short of analyst estimates, folks, even as the company said it's sticking to its long-term revenue goal. Company is aiming for annual revenue growth exceeding 10%, though it said it could rise 9 to 11%, a little bit of a range, according to a statement that it put out today. All right, this is one, don't talk about it a lot, but it's a top gainer in the S&P 500. Biorad Laboratories, ticker is BIO, and the stock up about 4% here. Heavy volume. Reports mid-February. I couldn't find any news that could move it today, but yesterday it was rated a new buy at Baptista Research. They put a price target of $435.60 and the stock closing at $329, so that's quite a bump up. And then, as I said, the best gainer of this week, Netflix. It was a top gainer again in the NASDAQ 100. It's up about 19% in the past 5 sessions, highest level in a couple of years. I think this is its best week since October of 2022 on that stunning subscriber jump. And analysts continuing to weigh in today, including Citi, which raised its price target to $555 from $500 and the stock closing at $570 and change. Tim, all yours.
Okay, well, you got the gainers, Carol. I got the decliners. I do want to start with Intel, that company tumbling the most in more than 3 years. This after coming out with a disappointing forecast. Perhaps unsurprisingly, CEO Pat Gelsinger said Friday in an interview with Bloomberg that this is an overblown reaction. Shares fell after Intel's first quarter projection for both sales and profit came in well short of Wall Street estimates.
I feel like he's like preaching patience to shareholders.
But how long has he been doing that?
A while.
That's the question, right? And it certainly seems like investors are losing that patience. Looks like investors are going to need patience when it comes to an airline merger that is increasingly looking like it's not going to happen. I'm talking about JetBlue and Spirit Airlines. Shares of Spirit falling more than 13% today. This company's been on quite the ride over the last few weeks. JetBlue warned that its planned $3.8 billion acquisition of Spirit may be terminated in the coming days, setting up a possible clash between JetBlue and Spirit over the deal. Spirit did push back later in a separate filing, saying it, quote, believes there is no basis for terminating the deal, saying that Spirit will continue to abide by all of its obligations under the merger agreement, and it expects JetBlue to do the same. And finally, to a company that reported earnings after the bell yesterday, KLA Corporation shares falling as much as 5.4% earlier in the day, finishing, though, down by 6.6%. This after the company provided guidance for the third quarter adjusted earnings per share and revenue that fell short of estimates, this at the midpoint.
All right, guys, I want to check in on the bond market real quick because it's macro, so, we got it. And we got a lot of macro stuff for next week. We are seeing a sell-off all across the curve today. It's a 2-year, though, that's really feeling it, particularly as you get the core PCE actually did relatively well. By well, I mean sort of move around to that 2% level that the Fed looks at, up by 6.2%. But, remember, we're talking about it. It still feels like an orderly bond market. There's a huge range that many analysts wind up seeing, but it still feels like an orderly move and an orderly sell-off.
Yeah, there's definitely been a little bit more muted. That obviously could change a lot when we get to Wednesday and we actually get the Fed here. And that really gets us to the heart of the issue here, that this is a market now that has really kind of been left to its own devices for like the last 2.5, 3 weeks or so here. That changes in a big way next week with the Fed, and it changes in a big way next week with that slate of earnings, including from 5 of the Magnificent 7 stocks.
Yeah, that's going to be big. And of course, we've got the Fed meeting, and then we've got another read on the labor market. Having said that, let's talk a little bit about labor, because I know we've seen some layoffs, right? We've seen it with Salesforce. We've seen it also with, what am I thinking?
There are a ton of companies just coming out today. Flexport, according to the information, says it's going to cut several hundred roles. We saw Levi's jumping because of a job cuts announcement.
Microsoft.
Polestar is cutting roles. I mean, they don't seem few and far between anymore right now. And I think right now it certainly is anecdotal, Romaine, but there's still Goldman Sachs is tracking it with a layoff tracker.
Well, and if you go, and there's some great layoff trackers out there that you can use online to show that there has been an acceleration in these. I think what's interesting, too, is some of the announcements that we've gotten this week, and don't forget some of the media sites that also announced layoffs here. I think the percentage of workers that are being laid off is more significant now than what it was, I think, when we were talking about this a couple of months ago. It seemed like before you was talking about low single-digit layoffs in terms of total number of employees, and now we're kind of at that high single digits, low double digits, and I think that's when you have to get concerned about how that feeds into the macro story.
Yeah, and then where that labor hoarding is, right? You can make an argument that some of the railroad, those guys, they're not going to be laying off workers anytime soon, because it was very hard for them to get it. So there's that aspect, too. What I want to bring in is the Journal had a really interesting article that said that a lot of the workers that are working remotely are more easily laid off than those that come into the office. Now, we've all been in the office since, what, July of 2020? But nonetheless, I found that to be very interesting. Is that true? July 2020?
Yeah, some of us been here longer than that, Alex.
Something like that. They wouldn't let me come in.
That's a whole nother conversation.
They wouldn't let me come in.
Tim, I don't think you ever stopped.
They told me I got a job and I had to come in that day.
Must be nice. But yeah, your point is, but I saw that story too, and it makes you wonder here how that's going to shake out. Is this sort of that end of that remote work, hybrid working environment, particularly if now they're going to hold it against those folks at home?
I think it's more of a question about stability. People who are willing to work remotely for different reasons, lifestyle reasons, they want to live where they want to live. And they spoke to some of these folks in the article who said, it's okay to have this uncertainty as long as I get to do what I want to get to do, which is, live in these other areas. So
I think it's going to be tricky. There's a lot of employers who come in and companies that come in and talk to us, and they say we want to be able to, that workers want that flexibility of maybe being in the office or being at home. So,
wait, how do you get to work 4 days a week?
I didn't. I worked 5 days, guys.
Okay. All right.
And you're late.
Okay. I support you, Carol.
Thank you. I know you're with me. All right, that's a wrap. Goodbye to the three of you, not you, Romaine. All right, that's a wrap. Our cross-platform coverage, wrapping up the trade.
1, 2, 3.
Don't do the math.
I don't know what's happening over there.
Wrapping up the trade on this Friday.
Because you started the wine segment earlier.
I hear nothing. All right, join us again on Monday. We will all be here. Our cross-platform, radio, TV, YouTube, Bloomberg Originals.
Actually, no.
No, turn his mic off. Turn his mic off. All right, guys, we'll see you on Monday.
All right, and we continue our coverage right here on Bloomberg Television. It's Friday, and Chris Kane joining us back here on the program for a look at the factors that fueled this week's market moves. Factor Friday coming up after the break, right here on The Close on Bloomberg.
Welcome to The Close. I'm Alex Steele alongside Romaine Bostick. So it's been quite a week, and I want to kind of point out a couple of the trends that we've been seeing. One is S&P versus the S&P weighted index. And this just basically goes to show you that it was really tech for a large part of the week that was outperforming. Now, I appreciate that today they're kind of trading together, but the orange line is the S&P, the white line is the equal weighted index. You can really see that divergence that took place on the 24th, so smack dab in the middle of the week. And the big answer to that is, well, of course, it had to be tech, particularly when it comes to Netflix. So let's take a look at this, because this shows the Mag 7, the orange line, versus Tesla, the white line. So it's kind of Mag 7 -1 at the end of the day. Tesla just really had a tough week after earnings, but Netflix really helping and sort of propping up the market. And then you had the likes of Amazon for today, for example, hitting a 52-week high. Another part of this story is Microsoft. Take a look at this. I just love this story. I called IBM boring, but Microsoft feels fresh to me, climbing to $3 trillion in a market cap and just ending right on that level. Key, particularly as we head into earnings next week, where it's really going to be about cloud revenue. They seem to be firing on a lot of different cylinders. And the question to me is, will this market cap and will the run that we've seen in Microsoft actually hold? How good do the earnings have to be in order to justify where they're trading? Many analysts are saying, like, yeah, the PE is justified, Romaine.
Yeah, absolutely here. And of course, as having one of the biggest weightings in the index, it could be a big driver here for what happens here in the final trading week of the first month of the year. Let's get right to it with Chris Kane here on our Factor Friday and a look at some of the factors here that have been moving the market so far this month. Chris, of course, equity strategist for us here at Bloomberg Intelligence. So let's start off right now. I mean, I mean, I know January is not quite over. We've still got 3 trading days left here, but what are the factors that have been most responsible for what we saw so far?
It's been a good start to the year for traditional factors. So, things like high momentum stocks have beat low momentum stocks by about 6% in a short 3 weeks. Things like high profitability is beating low profitability by about 4%. Low vols beating high vol by about 4%. So those are like very traditional factors. They're doing very well. Value is lagging a bit, about flat on a long short basis. We do formulate a multi-factor definition, so we call it MVP. That's a momentum, value, low volatility, and profitability. That's up about 5% on a long short basis. So after a back and forth 2023, factors have certainly started on a strong note this year.
What do previous all-time highs, though, tell us about how the index will perform after the fact? Like Bespoke had a nice note out that was like, hey, January is good, the rest of the year could be really good, and total return is going to be great too. Yeah,
we looked at, as you know, we hit an all-time high recently, right? So we looked at times when the S&P 500 hit an all-time high after a drawdown of 20% or more. So basically after a bear market. The performance in the subsequent 6 and 12 months is very strong, higher returns than normal. A lot of people have kind of pointed that out. But to me, what's even more interesting than that is the risk. So the risk seems to be much lower after our all-time highs. You can measure this a couple ways. So for example, you can look at the volatility of the subsequent 12 months after all-time highs. That comes in at about 11%. That's a good bit lower than the 15% volatility the S&P has displayed since 1950. Similarly, the worst case scenario, at least historically, was after we hit an all-time high in 2007. We declined 6% over the next 12 months. That's the only negative reading we've seen. And again, that's still not too bad either. So it certainly has been a positive sign historically to buy these all-time highs.
So when you look at that data here, does that sort of signal a broadening out potentially? So if we do get those gains, we talk about 9% on average here based off that main metric here for the half year. Is that going to be a broadening out of the rally, or is this going to be more about momentum and, quite frankly, back to what we saw at the start of 2023?
I would think broadening out. I mean, we looked at obviously factor performance after these all-time highs, and the traditional factors like value, low volatility, again, profitability, they all work. So that does suggest that it's a broad-based rally. It's not just a Magnificent Seven driving it. So I would think it's a broad-based rally going forward.
All right, Chris Kane here with a closer look at the factors on Factor Friday, the factors that have moved the market this week and so far this month. Of course, the economic data also a big part of the market moves that you've been seeing. And we got core PCE data this morning, the Fed's preferred inflation gauge, and it cooled to an almost 3-year low. That's even with robust holiday spending in December. We had a chance to catch up with Deputy Treasury Secretary Wally Adeyemo a little bit earlier today.
We know that there's more that we need to do in terms of trying to make sure that we put more money in the pockets of the middle class in America, and that's exactly what the President and Secretary are committed to doing. We're not declaring victory, rather we're saying we've made progress, and we're going to continue to make that progress going forward.
Deputy Treasury Secretary there, Wally Adeyemo, and joining us right now is the chair of the White House Council of Economic Advisors, Jared Bernstein. Talk a little bit more here about economic conditions. The last couple of reports that we've gotten, Jared, have been pretty good. A GDP report that showed strong growth in the final quarter of the year, and now those main inflation metrics that the Fed looks at continue to show disinflation in December.
Mm-hmm. Right. We've been trying to execute on a plan that President Biden put in place a while ago. And at the heart of that plan is to maintain the very strong job market, the fact that the unemployment rate's been below 4% for almost 2 years running now, with easing inflationary pressures. Now, that combination supports rising real compensation, rising real pay. And in fact, wages have been beating prices, and more so for middle and lower wage workers than higher paid workers. We've had real wage gains now for about 10 months in a row on a year-over-year basis. That's helping to support consumer spending, 70% of the economy, and it's been showing up not just in the hard indicators, which you've been talking about, which are so important, but you've even seen it showing up in some of the sentiment indicators, which have really surged in the last couple of months. Like Wally said, we've got more work to do, but it seems pretty clear we're moving in the right direction.
Well, let's talk a little bit more about those sentiment indicators and look a little bit forward. We know this data is backwards looking, and you have to know there's a lot of fear that the strength that we saw in the economy in the last few months might not necessarily persist through 2024 here. How is the White House accounting for the idea that anecdotally we've already seen a lot of layoffs at companies, maybe not enough to show up in the job market data, but there's a lot of fear that that could accelerate?
Well, I guess I would argue that if the sentiment indicators are accelerating, and now let's talk about University of Michigan, that's up 29% in December and January. That's the biggest 2-month surge in over 30 years. Same consumer confidence also had a great pop in the last read. So if anything, it would seem like some of the conditions that we're describing seem to be finally reaching people in a way that perhaps they hadn't before. Mm-hmm. So look, there's always layoffs every labor market has layoffs. The question is, on net, are you creating jobs at a solid clip? And I think the data are very solid in that regard.
Hey, Jared, it's Alex. Last time we talked, you called me Debbie Downer. That hurt. No, I'm kidding.
Sorry, Debbie. I mean, Alex.
But I'm going to double down on my Debbie Downer here, because part of why
double down.
But why do people feel better is because gasoline prices have been coming down, which makes sentiment so susceptible to that cyclical part of PCE. And then you get more news about disruption in the Red Sea, specifically the missile hitting Trafigura and oil tanker. There's no way the administration can combat that kind of sentiment. What do you do with that?
Well, again, I mean, I think that the numbers speak for themselves. And what I tried to express a minute ago was the fact that when you have the tailwind of a reliably strong job market behind your consumer sector, when you have your investment sector posting some of the largest gains in manufacturing facilities, the construction of manufacturing facilities that we have on record going back to 1959, those are some potentially lasting tailwinds. Now, look, there's always risk factors in the economy. You've just named a couple of them. But at least as far as the conflicts go in the Middle East and in Ukraine, the impact has been limited on energy prices, I think considerably limited. And as you mentioned, the gas price this morning was $3.10 a gallon. That's down from $5 a gallon in June of 2022. So that's $1.90 per gallon relief at the pump. That's also helping with some wind in the sails of consumer spending. We have to watch all these risk factors you've raised. They're definitely relevant to us. But again, as we see these numbers begin to show up in more positive sentiment indicators, I think we should believe them.
All right, Jared, here's a non-Debbie Downer for you. Would you guys categorize this as a soft landing, and is it sustainable?
Well, I think in terms of sustainable, that links up to what I was just talking about. Let's take a close shave with Occam's razor here. If you have an economy that really is moved along by consumer spending, and you have a labor market that's pretty much at full employment, and you have prices now with a core PCE that's been running at 2% for 6 months now in a row, and that's Q3 and Q4. We learned about that in the GDP report on Thursday. So the core PCE running at 2% annualized for the past 6 months, that is a recipe for, I think, continued momentum moving forward. As far as a soft landing is concerned, I think anyone who would look around would say that the plane is on the ground, given these recent numbers. I think the tougher part is to look around the corner. I leave that to many of the forecasters, but I guess I would say that momentum story I just told should be one that the forecasters are certainly putting in their models.
So the plane's on the ground, but maybe you can't see the gate yet. We'll go with that metaphor. We'll check back in next time and see where we're at. Here, Jared, always fun to catch up with you. Thanks a lot. Jared Bernstein of the White House Council of Economic Advisors. So coming up, there is a new contender in the weight loss drug competition. More on Eli Lilly's new obesity shot next. Now, this could be just huge. And imagine if it gets into a pill form, Romaine. That would be insane. We'll discuss. This is Bloomberg.
When I look around this room, I can't help but wonder, is Ozempic right for me?
Ozempic has been around for several years now, and it was a treatment for type 2 diabetes. In 2022, it started entering the public consciousness.
Ozempic is great for people whose parents can't cook.
Like, shut the up. You're on Ozempic.
The biggest corporate beneficiary of the drug's popularity has been Novo Nordisk.
Ozempic's success has turned Novo Nordisk into Europe's biggest company, with a valuation of $450 billion. But a new contender has entered the ring.
Eli Lilly also now has a competing drug. It's called Zepbound, and it looks to be even more effective than Novo's drug, and it also is a little bit cheaper.
It's really set off a horse race between these two fierce competitors to see who will take the biggest part of this enormous market.
In 2019, Lilly and Novo traded at comparable levels to the rest of the pharma industry. Since June 2021, when the FDA approved Wegovy, the stock's valuations have soared, tracking alongside companies such as Apple. They're being valued on how much they're likely to grow in the next few years.
So the obesity market was worth $2.5 billion in 2022. We estimate that this market could be in excess of $80 billion by 2030.
Because now we have two competitors in the space, it's just going to make the whole market bigger.
A closer look at competition in the weight loss drug industry. One of the big stories in Bloomberg Business this week, written by our next guest, Madison Muller. A closer look at Eli Lilly's entry into the market, and quite frankly, I guess an entry that they could have done maybe years prior if they had listened to one of their scientists.
Yeah, so 30 years ago is really when all of this research started, which is hard to believe that research that started 30 years ago is now sort of only coming to fruition. But Eli Lilly did not have the first mover advantage here, but what we're seeing is they still might have the best-selling weight loss drug of all time, and that drug is called Zepbound.
Why?
And Zepbound is, so it's a GLP-1 drug, which Ozempic, Wegovy, which are pretty much household names at this point, are GLP-1s. Zepbound combines GLP-1 with another gut hormone called GIP, and that combination actually makes it more effective for weight loss. So in trials, we saw up to 21% loss of body weight in some patients, and it also looks to potentially have less side effects.
Is it if you're a first mover advantage in this space, does it actually eventually matter?
So in other industries, I feel like it does. We see so many examples of companies that innovated too late, weren't
like
first.
Netflix and Disney.
Exactly.
Perfect examples.
Yes.
Mm-hmm.
And so in the drug industry, what we see time and time again is it's not always the first mover. It's not always the first drug to the market. It's ultimately the drug that's the best that ends up winning in the end.
Do you feel like this, how do we know if investing in this and the right valuation is a fad or legitimate based on sales?
Yeah, I mean, that's an interesting question, and that's something I've been asking myself. And right now, Lilly's valuation is so high, and it's so much higher than its peers. And what I just keep hearing from analysts and from investors is that they do think that Lilly is going to be able to live up to the hype, that, you know, in the next few years, their growth potential really is, it's realistic given the pipeline that they have and their diversified portfolio and sort of their history just being a large pharmaceutical company based in the U.S. that has delivered these blockbuster drugs before.
All right, well, it's a great read. You get in the Bloomberg Terminal or in Bloomberg Business Week. Madison Muller there. A closer look at the competition in the weight loss drug industry and Lilly's entrance into the market. Coming up after the break here, a focus on investing in early stage companies. Our next up segment is Next Up. This is Bloomberg. Welcome back. It's time now for our Next Up segment, where we highlight the entrepreneurs moving the needle in our markets, in our economy, and of course in technology, and of course the venture capitalists who help to fund them. Our next guest is the founding partner of a fund whose portfolio companies focus on aging and longevity. Tracy Chadwell is founding partner over at 1843 Capital, and she joins us today from our DC bureau. Great to have you here, Tracy. I want to start off here with the general sector overall. There's been a lot of talk in public markets about the attractiveness of sort of taking advantage of demographic changes, if you will, here. But a lot of that activity right now is actually going on in the private markets. We've seen a lot of activity, new entrants to the market and tie-ups there here. Give us a sense here at the difference between what's sort of in the pipeline in the private space relative to what's already out there in public markets.
Thanks, Romaine and Alex. It's so great to be here. I really appreciate it. Obviously, the private markets are leading what happens later in the public markets. So, you know, one of the things that we always try to achieve is public market exits for some of our portfolio companies. And right now, our focus is on the macroeconomic trends driven by older adults. Right now, we have 100,000 people over the age of 100. The oldest person is 116 here in the United States. And of those, right now, the demographic of 50 to 64, they have 90% cell phone penetration. So we're really talking about an adept population that also has a tremendous amount of wealth. 80% of the wealth in this country is held by this demographic. We are talking about a $14 trillion silver economy here.
And I mean, anytime you see these types of big sort of structural demographic trends, I mean, it's very easy to look at that and say, okay, this is where the money is to be made. But actually being selective and picking the right companies is a much harder proposition here. What is sort of the weed out process that you take there over at 1843? I guess to just figure out not only the companies that could benefit from this, but more importantly, the companies that will execute.
You're absolutely right. And just looking at the demographics doesn't do it. We are very thesis driven, and we take a look not only at the opportunities and the problems that could be solved with technology, but also, too, who's out there willing to pay for these things? And are they real problems, or are they solutions in search of a problem?
So what's also interesting, too, is that the longer you live, then the less money you have. So then that creates like its own weird issue. But you're not alone in looking at opportunities for boomers, for example. Uma Moriarty, we spoke to her in the last hour from Center Square, I should say. She was talking about how for REITs, this is a real area for her. Listen up to what she had to say.
Being real estate investors, really focus on fundamentals at the asset level. Think about things like from the perspective of demographics. Right? We have all of these people aging into the older generation, baby boomers that are aging into the need for healthcare, things that are more secular in nature rather than cyclical in nature. And then also really focus on making sure that these companies have a strategy as it relates to their balance sheet, making sure in the real estate space, right, we're seeing a bit of a reset happening in the private markets.
So Tracy, translate that into your investment world. Like, what's a top pick right now?
Yeah, I think if you're anyone and you don't have an older adult strategy, you're really missing out here, because this is where all the capital is. And we've really been focusing the last few years on digital health solutions and technologies that can help people stay healthy. You know, companies like Recuro Health, which is bringing healthcare to the masses and people in remote areas to keep them healthy so that they can live to 100 as well. And then companies like our company Tender, which we just invested in, which is a connected care company which helps families stay connected to their loved ones as they age.
Tracy, I have to be honest, my mom is 81 now. She can just turn on her flip phone, and my 9-year-old daughter has shown her how to text. How do you bridge that gap?
Yeah, I think it's really interesting because we are coming to peak boomer. We're going to have 12,000 people turning 65 next year. Those are digital natives. They are willing to age using technology, which is really exciting. And for now, even though penetration rates over 65 are about 53%, you do have a lot of the users in the millennials and in the Gen Xers that are supporting their older parents that are using technology to do that.
So I do want to pivot and just talk a little bit here, Tracy, just about the overall VC and private environment right now. We know last year was really challenged given the jump up in rates and all of the concerns here about cost of capital and some of all the companies that were already in the pipeline here. Have conditions eased up a little bit? Are they a little bit more attractive right now, particularly when it comes to deploying new money?
Well, it depends on whether you're talking about attractive in terms of valuations of companies. The seed stage and Series A stage has always been strong, and I think that's because of an influx of a lot of new seed stage funds. And the later stage funds are starting to deploy. We just had our company May Mobility, which is focused on autonomous driving, and actually just won a contract with the city of Detroit for driving older adults and drives older adults in Arizona as well. They just raised a Series D of $105 million. So I think that capital markets at the private levels are starting to ease. I think that they're starting to see that they're going to miss opportunities, that this could be one of the best years in starting to prepare for a true IPO market opening up in the next several years.
What do rates have to look like and the overall macro environment have to look like to sort of help that situation?
I think rates really help when you're talking about exits to financial buyers, to private equity funds. But if you're talking about the IPO markets or strategic sales, you're talking about really strong top-line growth and EBITDA potential.
Tracy, great conversation. Tracy Chadwell, founding partner of 1843 Capital, a focus there on, I guess, some of the demographic changes, structural changes here when it comes to seniors. And, I think, we're kind of, I think, believe in the same
thank you so much.
age demographic. So we're kind of both dealing with aging parents, aging family members. It's a big concern here. And the costs associated with that, in case you've looked, can be pretty onerous.
And I'm also under the assumption that, like, I'm not going to really get Social Security. So I'm kind of looking.
You've given up on that?
I'm just like,
I'm holding out for that.
If
That's
I
all
get
got.
it, cool. If not, okay, I have to prep for it without it. So, like, in 40 years, I have to have enough money to support myself without the government help. And if I live till I'm 100 or 110, oh my God.
But it gets to the idea, too, that these are the solutions that we need, right? I mean, that they're and the aging of the population and all of the things that feed into that. And we know there's just so much that's broken in that process right now. So hopefully some of these new companies, in addition to being profitable themselves, will somehow make it profitable for the rest of us as well. This was a pretty interesting week here in financial markets, Alex, as we close out the trading week here. We were down on the day for the markets, but we should point out all of the major indices did end the week higher here. And that's significant because we came into this year and everybody said, are we going to get a repeat of 2023? Is that rally that we saw towards the end of the year going to continue into 2024? And at least through these first 4 weeks, it has.
Yeah, and also I should point out that maybe not today, but overall, this was not a terrible week for small caps.
No,
like,
they
had a couple super
actually.
solid days after that GDP number in particular.
Well, you saw the Russell was up like 2%. I mean, the S&P was only up 1%. So you're talking about outperformance on the Russell, and that gets to this idea of whether people are willing to sort of broaden out beyond the Magnificent Seven and the other big caps.
But they've been a value trap before.
Yeah.
So there's that. Absolutely
here. And of course, next week, I think those two lines at the bottom of your screen, the dollar and that 10-year yield, are going to be a much bigger factor here for equity markets, particularly with that Fed meeting on Wednesday. All right, stick with us here. When we come back from the break, a look back on this day and the invention of the television set.
Ooh.
And we're going to leave you with a question before we go to commercial, Alex. What is the average size in inches of a new TV set sold today? Think about that.
I'm thinking.
This is Bloomberg.
We have some breaking news for you right now. Former President Trump must pay $83.3 million for defaming Ejon Carroll. She had been looking for about $12 million in compensation for damage to her reputation caused by President Trump's denials. And now the judge ruling that Trump must pay $83.3 million for defamation. Romaine?
All right, Alex, let's pivot from that here and open up the almanac. Back on January 26, 1926, the Scotsman John Logie Baird invited a group of scientists to his lab in London to show off what was a rather crude device. Basically, it was just a radio with a neon tube behind a mechanically spun disc, but it processed images to a screen of about 12 inches in size. That event is now known to be the first public demonstration of true television images. While Baird didn't invent the technology, he did help popularize it. And with the help of his scientific peers across Europe, America, the Soviet Union, and Japan, that crude mechanical device had within 20 years morphed into a crisper and more consistent electronic device with the cathode ray tubes, and a transition that led to widespread adoption of the technology. By 1953, more than 7 million TVs were being made in the U.S. each year by more than 90 companies that included GE, Magnavox, RCA, Zenith, and Westinghouse. By the 1970s, most TV set production had shifted to Japanese brands, and by the 1990s to Korea and China. And that brings us to our big number and the answer to our question of the day. While early TV sets had screens barely 12 inches, what was the average size of a new TV sold today? The answer, 50 inches. But while the average size has increased, average sales have not. Sure, more people own TVs than ever before. About 1.7 billion households, to be precise, have at least one. But the growth rate in new purchases has been anemic. Shipments of LCD panels were down about 10% last year, OLED screens down 3%, and smart TVs down about 6%. Bloomberg Intelligence sees panel shipments falling even further here at the start of 2024. And for content providers, the average revenue generated per TV user has been steadily declining for the past decade as eyeballs and ad dollars shift to computers and smartphones. Now, there is a silver lining there, and that is that TV sales often spike around big sporting events, and there are a few this year, including the Paris Olympics, Euro 2024, and in 2 weeks' time, the NFL Super Bowl. Alex?
Oh, my bingo card had 40. I thought it was going to be 40 inches. 50. This makes sense. All right. Well, that sort of sets us up nicely for tech. I don't know, TV tech. That kind of makes sense. You got a busy earnings season next week. You get the Mag 7 stocks like Alphabet, Microsoft, Apple, Amazon, Meta, all of that coming out next week. Let's get a preview of what to watch in some of the big chip tech stocks. Stefan Solinsky is global head of software research at BNP Paribas Exane. All right. Good to see you, Stefan. Let's start with Microsoft. Very interested. Will the numbers be enough to justify a $3 trillion market cap?
We think so. So when you look at Microsoft, I think the three things investors will be looking at is first, that Microsoft Azure growth number. So they were a bit cautious with the guidance, guiding for 26 to 27% growth, which actually is a deceleration off of what they did last quarter. We think they do 28%, consensus is around 27%. So that's going to be important to see that that holds up quite well. The second thing to look out for is on the operating margin. They had a 330 basis point beat in the first quarter. We think their full year guidance is quite cautious. They didn't really roll that forward to the full year. They've got a June year end. So we actually think that they do beat by 130 basis points. Wow. But the wild card will be Microsoft 365 Copilot. This, of course, is their Gen AI product. And that's where we think uptake has actually been quite slow. But we think the market is now accustomed to that. 6 to 7 months ago, that's where all of the hype was. But we think that the uptake's been slow, and that's more of a fiscal 25 issue for them.
Well, speaking of AI, the FTC is looking into some of the big techs and their relationship with, say, ChatGPT and OpenAI. Is that going to be a risk for a company like Microsoft that has gotten so far ahead in AI because of those relationships?
Yeah, so the government's going to be looking at all three of them. So Amazon have the relationship with Anthropic.
Sure.
Google have their own large language model, but they've also developed some of these relationships with Anthropic, and of course Microsoft with OpenAI. So we've already seen that risk somewhat materialize for Microsoft with some of the governance issues around OpenAI. So for the time being, we expect the governance at OpenAI to improve. We expect them to announce a larger board. But yes, you're likely to continue to see some scrutiny on those relationships across the board.
For investors, though, do you think that AI is going to continue to be the story? And I mean that particularly in the perspective of any additional gains in the stock here, or has that kind of been pushed to the side in favor of other topics?
I think AI in general, of course, will be a topic this year for all of these stocks. There is a risk it's a gap year. So 2023 was when AI emerged, and we really see the first monetization really in 2025.
Yeah.
So the question is, can they maintain this momentum?
Yeah.
We think for Microsoft they do, but mostly through Microsoft Azure. Again,
Right.
we think the Copilot numbers could be a little bit quiet.
This gets also to the larger issue about some of the legacy businesses, if you will, if we can call them that here, particularly when it comes to Azure, Amazon Web Services, and of course also Alphabet's offerings as well here. What's the competition like there? I mean, last time I checked, this was still kind of a duopoly to a certain extent, though I know Alphabet has kind of tried to come up a little bit.
Yeah, so last quarter, Google Cloud disappointed with their growth rate in sort of the low 20s. And so that's one thing we're looking out for as a wild card for Google is, does that re-accelerate this quarter? We think it does. But clearly, the Google Cloud momentum, Oracle Cloud Infrastructure momentum has probably been a bit disappointing, and it does look like Microsoft and AWS are dominating. But within that, over the last 12 months, we've seen Microsoft Azure take share from Amazon Web Services. So that's what people will be looking at closely. Will that continue? And that would be a benefit to Microsoft.
So what are you looking at for Amazon Web Service growth?
So Amazon Web Services, they did 12% last quarter. The market's looking for at least, we would think, 13% to be comfortable
Anything over 12
with
is okay.
I think anything, they do round, so I think 13 is what they do need.
Okay.
But the other thing with Amazon, of course, is their North American margins. So it used to be kind of a one-trick pony, just looking at Amazon Web Services. But now the market is now looking at their North American business more broadly and the margin story there. So we think that also is important.
With regards to Alphabet specifically, how much are ad sales and the health of ad sales going to be the story when we get that report?
Yeah, I think there's three things there on Google. One is the ad sales, of course. I think the consensus has 12% growth. We're at 13% on a reported basis, but in line on constant currency. Second thing is margin. It's going to be a noisy quarter in terms of margin. You have the NFL Sunday ticket costs that are going to be in the quarter, potentially some legal costs. They don't really break them out all the time. So we're actually below on margin. I think that's going to be another talking point. I mentioned the Google Cloud. That's going to be in focus to see if it reaccelerates. And also the market's waiting on maybe the announcement of a new CFO. They have said there will be a transition. We went from the year of efficiency last year. We think we have years of efficiency in the sector. We've seen more layoffs already. Actually, will Google follow suit?
On that efficiency, though, you think they're going to continue down that road? I mean, I remember when Mark Zuckerberg first said that. I mean, everyone kind of snickered. Yes. And, of course, ended up being really prescient here, and every other company basically jumped on the bandwagon. Are they going to stick with that belt tightening?
We think so, and we're seeing it across the industry. SAP this week laying off 8,000 people, driving margin. We've seen it with Amazon thus far this year, with Google as well. And so, again, we think we go from the year of efficiency to years of efficiency as companies begin to use Gen AI and AI to automate more of their internal operations.
All right, Stefan, always great to talk to you. Stefan Slowinski there over at BNP Paribas Exane here. A nice breakdown here of some of those big cap tech names, actually the biggest of the big cap tech names, if you will, particularly when it comes to Microsoft, Alphabet.
And I'm going to miss all of them.
Amazon here. You can still stay up late, over there when you're traveling. You're going on like a European vacation or something? Is that what's happening?
No. I'm going to Oil Services annual meeting, though it happens to be in Florence, so I will definitely be asleep when these numbers cross. But, I'll think of you when I read the reports.
Well, we expect a lot of reports out of you there, just to know you're working, Alex. All right, Alex has a big lot on her plate here for next week, and investors are going to have a lot on their plate as well here. We're going to set you up for what to watch over the next week ahead. That's coming up next here on The Close. This is Bloomberg. There was a lot going on this week, a lot more going on next week, including Jay Powell and the Fed, a two-day meeting, of course, the big rate decision on Wednesday, and more importantly, the press conference and commentary. Joining us right now as to what to expect is David Wilcox. He's the director of U.S. Economic Research at Bloomberg Economics. David, thanks for being here. We're not expecting, of course, any change in rate policy itself, but there's going to be a lot of questions here about the path forward and all those rate cuts that have been priced into this market.
Yeah, I think the atmospherics around next week's meeting will be really important. A couple of things that I'll be watching for include, first, there's a sentence in the statement at the moment that indicates the committee has a tilt toward tightening policy from here forward. The sentence says, in determining the extent of any additional policy firming that may be appropriate, and then it goes on. I think they're going to need to change that to something more neutral along the lines of something like in determining the stance of monetary policy that's appropriate to achieve the 2% inflation objective. And that will, I think, bring some clarity that they think they're done with the hiking campaign. And then secondly, you were referring to the pricing of future cuts. It'll be interesting to see whether Powell tries to nudge those in one direction or another.
Well, how would he do that, David? So, I mean, we've obviously reduced the odds of a hike from March from like 80% to let's just call it 40. Does he need to get that down more? And how does he do that?
If I were in Jay Powell's shoes, I'd be very satisfied with where that market pricing is right now. It's close to a coin cost on March for 25 basis points. I think that's fine. That leaves them plenty of running room to either cut or not, depending on what the news shows that comes in between now and that March meeting. If I were Powell, I'd be aiming to try to get out of that press conference having disturbed that market pricing as little as possible.
All right. Well, we'll see if you can thread that needle, David. As you know, some of us reporters can be a little feisty there. David Wilcox, one of the best in the business there, now working for us here as Director of U.S. Economic Research over at Bloomberg Economics. So now we take a broader look here at some of the other events here that could potentially be market moving here. And let's start off here in your wheelhouse, Alex Steele. Baker Hughes, a big meeting next week.
So we have our annual general meeting that happens in Florence, Italy. So don't hate me. I'm going to that.
Okay, I hate you, but good luck.
But Baker Hughes is quite interesting. It's an oil services company, and we just got that headline from the Biden administration that they're going to sort of put a moratorium on LNG export build-outs. This is huge for all the companies that are going to be there.
Yeah, I think Bloomberg's sending me to Topeka, Kansas in a couple of weeks here. But Florence sounds nice
You
here.
want to DC. We're
also getting a lot of tech earnings, as we have been talking about, and that includes Apple, Microsoft, and a few others.
I wish I could get excited about Apple.
No? You're not excited about Apple?
I just, iPhone, schmyphone. I mean, sure, all right.
Well,
fine.
from the perspective, though, of whether the rally continues here, I mean, we are talking about the biggest weightings in the S&P 500. So as they go, so goes the S&P. That will be a big catalyst. And, of course, on Wednesday, the FOMC decision.
So what I love about the FOMC decision is what Michael McKee says in the presser, because that inevitably, his question is the one that always gets quoted in all the analyst notes. So we got to ask him what he's watching.
Well, of course, we have the best and the brightest here at Bloomberg. 2,700 journalists and analysts, I'm told.
In more than 120 countries and something else.
More than 120 companies. And that gets us to the end of the week here. If you're tired of the macro, well, you're going to really be tired by Friday. A big jobs report, the latest monthly numbers coming out of the U.S.
Really interested about JOLTS, too, that we wind up getting that earlier in the week and sort of how that's going to play out.
We have that, always that drumbeat to the jobs reports with the ADP numbers and JOLTS. Maybe you get a read here. And then you get to that big monthly report here. And look, the trend line has been set here. I mean, this is the labor market still healthy, wages still rising here. Whether we see softness there remains to be seen.
Yep. And where? What industries? After the holidays?
All right. We really appreciate you joining us here on The Close. We will be back next week for all of your markets coverage of everything going on in the markets, the economy, and with corporate earnings. In the meantime, stick around. Everything Politics is up next with Balance of Power. This is Bloomberg.